Hello, how are you all? Hope you are all doing good. I am Dr. Labib from Dr. Labib Academy. Welcome back to my channel. Today we are going to have regarding ACCA, strategic business reporting. Okay, today we are going to discuss regarding non-current assets in detail. I kindly request you all to subscribe to my channel, share this channel, post your comments. That's very important. Slowly and steadily, the followers are growing up, increasing, and post your comments and watch till the end. Anything is there, just let me know so that how best we can improve the things. So please subscribe to this channel. And this is in this series it is 9. Okay, this 9 is nothing but in the sequential order. Okay, 9 by 25. 25 will change as we are increasing the 25 is nothing but the total number of more probable number of videos which we are going to have. That will increase. But the most important thing is this is the series 9. Okay, in this section. Okay. This is SBR. We are going to cover something on specifically with respect to non-current assets. Okay. See, when we say it's a non-current assets, immediately what it goes to our mind is we will talk about IAS 16. Okay, International Accounting Standard 16. When we say it's a IAS 16, as simple as that, we have property, plant and equipment. Fine. Take the things. It's a very simple. Now we will go what are the nitty-gritty things that's involved in IAS 16 non-current assets. We are having very specifically 1, 2, 3, 4, 5 and 6. There's so many things that is involved in IAS. See, this will be in 2 or 3 parts. Okay, this lecture is very big and it will take little bit more time. Okay, coming back to this, what we are going to discuss in terms we want to know how we are going to recognize it and when we are going to de-recognize it. Is that, see, recognize it means how you are going to identify it in the balance sheet at the time of acquisition, at the time of addition. Okay, at the time of addition. And derecognition means at the time of disposal. And how we are going to measure the non-current assets, including, see, this is very important in terms of impairments and revaluation. Fine, this is the first part. Second part is we want to know how the accounting requirements for the assets, non-current assets held for sale. There are very specific conditions that the non-current, we have covered this in the one of the previous lectures. There are some specific conditions are there where we are going to say that these assets are held for sale, and then only we have to identify under that category. That is the point number, objective number 2. Next, we also want to know how the accounting treatment for investment properties. Is right? Investment properties, including classification, recognition, measurement, and change of use. When we talk about the non-current assets, we will say it is going to be property, plant, and equipment. Non-current assets having, is that when you say non-property, plant, and equipment, IAS 16. Investment property will be IAS 40. We will cover this and discuss and apply the accounting treatment for intangible assets. Okay, intangible assets is nothing but IAS 38. Is it? We are talking about the thing. We will also discuss about how the borrowing cost when we have to capitalize it, when we should not capitalize it, when we should treat as a capital expenditure, when we should not treat as a capital expenditure. And apart from that, we are also going to cover a very major part with respect to government grants, how the government grants has to be treated. Fine. These are the various different aspects which you are going to work it out whenever we will see that how the things are going to be moved as such. When we say that how the what is the concept of government grants, is it the concept of the things here they have not mentioned something with respect to. There is another one which is there with respect to what? With respect to CGU. Yeah, with respect to what? CGU. We will talk about CGU, cash generating units as such. Okay, and somewhere we will also talk about IFRS. IFRS 5 is there. Is right? When we say it is where is that held for sale? Is it right? It is IFRS 5. Is it? It is going to be IFRS. These things we will cover in detail how best it can be worked it out. See, when we say it is related to right? IAS16, IAS5, I say here borrowing cost is nothing but IAS23, okay, and government grants is IAS20. These are the things. See, now you can understand how we are working in see how many standards we are saying. We are talking about IAS 1, 16, 40, 38, 23, 20, and IFRS 5. Okay, these are the major areas where we are going to focus. And every standard. See, this lecture is very important and very specific. It's not difficult at all. Wherever there is a difficulty level, I will make sure that it will work it out. We are talking in terms of, see, if you take into very specific, IFRS 5, okay, this is IAS 20, okay, this is IAS 23, okay, fine, this is IAS 38, is right, this is IAS 40, and this is IAS 16. 1, 2, 3, 4, 5, 6. Okay, these are the things we will cover. See, already people who have done financial reporting, is right. This has been examined. We have. If you go through my lectures of financial reporting, it has been mentioned there. Okay, the SBR will have more open-ended questions. Definitely, and they will say it is a real-life scenarios. Okay, now very specifically concepts are very important. Even we are missing one clause, one rule, one guideline. Definitely it will be very difficult to carry forward. What is IAS 16 talks about? It is very clear. We know everything, isn't it? We want to recap it. Use for any asset held for use in the protection or supply of goods or services, or for rental to others, or for any administrative purposes. Means anything which you are going to use. It's more or less, it is right, it's more or less fixed assets are expected to use more than one period. That's very simple. That is the basic difference between the fixed, when the moment you say fixed assets, it is going to be used more than 1 year. How we are going to have the tangible assets of physical substance. How we are going to recognize the most important, this is the point where people will test us, is that the examiner will test us. how best we are clear in our concept. An item of property should be recognized as an asset when there is a future economic benefit. This is the asset. When you say what is the asset? People say asset is what we own. Is it right? Asset is what we own. But if you go a little bit further, is that asset is nothing but it should have some future economic benefits which will flow to the entity. And we have to, as simple as that, we have to measure it reliably. Is that we have to measure it in monetary terms. See, when we say it is the thing, here we are talking in terms of quantitative, as well as here we are talking in terms of qualitative. That is what we are talking in terms of what? In terms of conceptual framework. See, once you are going through this lecture now, automatically you will have more clarity as such. Is it? What is the conceptual framework says? Concept says that the elements should be relevant and should be faithful representation. That as simple as that. We say it is going to be what? It is going to be true and fair. Is it? It has to be. The recognition of IAS16 and most of IFRS standard differ from the above because they are based on the previous version. Definitely, when we are talking about the things right now, there are so many changes has been taken place as such. Conceptual framework does not override the requirement of, means it will not make any, it will not override the requirements of what regarding IFRS and IAS. The recognition of property plant is therefore determined by reference to what? It is with reference to IAS16 only. Let's slowly and steadily. What is the property? How it has to be measured? Is it right? How it is? The purchase price, is it? The purchase price plus costs that are directly or through bringing the assets to the necessary location. Any transportation cost, is it right? Any transportation cost has to be added. Any carriage, is there any transportation cost has to be added. Next, the estimated cost of dismantling and removal of the asset at the end of the life. Okay, at the end of the asset life. See, what is, when we are saying what is the property, plant and equipment, what are the features? They should have a cost, they should have a life, and they should be a residual value. Is it right? It sometimes it will have, sometimes it will not have. That's subject to the situation where we are discussing this. Now, these are the things where IAS should not, see, put one line here, okay? IAS should not say that the following cost should never be covered. Administration cost, no, it should not. It should be in the operating expenses. Abnormal costs, repairs, wastages, cost incurred after the asset is physically ready for use. See, this is where you say we have to, how we have to capitalization of expenses, and how we have to treat the operating expenses. We should make a differentiation between capitalization and operating expenses. Cost incurred in the initial operating period, such as any losses, is it right? Operating loss. We should not deduct losses from the value of the asset, is it right? We should not do it. And cost of opening a new facilities, a new product, including introducing new product. These are all will come where this all comes under the category of advertisement and promotional cost. Promotional cost and advertisement cost, including the training cost, should not be capitalized. It's a very, very clear instructions. It has to be done. It should not be taken into account. And cost of reorganization of organizing the entire entity's operation should not be taken into consideration. Just be very clear about this. How the thing, wherever I put star mark, it's the point we have to understand. Yeah, as a result, we are talking about the purchase of constructed PPE products, samples might be produced that are sold. And these are the things that has been should be taken into consideration. What are the measurement models? See, this is where we are going to be tested. Very simple, very easy. Okay, understand the things. It's not at all a complicated. See, IAS allows choice between there is a cost model and there is a revaluation model. Is it right? When we say it's a cost model, it is based on the historical cost. When we say historical cost and current value asset, two measurement basis. Is it right? Current value, see, now you can have, it is the fair value. Always we take into consideration what? Always we take into consideration the fair. See, the moment we are thinking about this, okay, we are thinking about SBR, okay, we are thinking about SBR. Keep it in mind, okay, keep it in mind that it is a part of the fair value only. It will come. Which standard it is there? It is going to be IFRS 13, fair value measurement. This will always will part of this in the entire valuations and calculations. Will take the fair value will be a primary importance. They say that the choice of measures such as in the case of IAS16, the conceptual framework knows that preparers of financial statement must aim to maximize the relevance. See, always we little bit by nature, is it, as a student, we'll say that qualitative characteristics we don't give that much importance, but make it a point. Qualitative characteristics make a very distinct impression on the understanding of the subject. What the characteristics of assets or a liability, the ways in which the asset or liability contribute to the future cash flows. Many items of property plant generate cash flows, okay, indirectly. Many property plant and equipment, what will happen when you say property plant and equipment, there will some assets have a direct contribution. Is it right? Direct contribution. We can identify it. Some will have indirect contribution. Supporting contribution. Is it right? Supporting assets will be there. Is it? That's what it says. Indirectly being used in combination with other assets to produce goods for consumption. As such, the conceptual framework note that historical cost that is the only thing, is that historical cost is the basis. When we are saying historical cost, it is nothing but the basic requirement. Is that basic requirement for every other calculation as such, and it is more relevant. We can be relevant and it is reliable also. Some items of plant equipment such as land and building very sensitive to market factors. Is that if there is any sensitiveness to the market factor, in that case what we have to do? We have to take into consideration the fair value. Fair value. Is that when the price is right, the fair value of land and may materially differ from the purchase price. As such, it may be that the measurement based on the current value will provide, okay, measurement based on the current value will provide more relevant information. Such decisions it is only judge. See, that's what it says. When we are talking about judgmental, it will be, the entire accounting is based on assumptions, it is based on limitations. There are two things, is it? Now coming back to the thing. What is the cost model? Cost model is what we have done till now. Is a cost model as such. Cost model is nothing but we are cost less any accumulated depreciation and impairment losses. We have done impairment losses. We carry forward the same concept of impairment losses right in this lecture. Under the revaluation models, little bit careful on this. It is going to be carried on fair value less any subsequent accumulated depreciation. See, what is the difference between these two? Is that what is the difference between these two is, if we are taking the cost model, it is held at cost. If we are taking a revaluation model, it is carried at the fair value. Is it? It is carried at the fair value. This is the most. I'm using the Kaplan. Okay. I'm again, just I want to make sure that you should not have any doubt. I'm consistently using Kaplan as a reference for all my lectures. Okay. And please subscribe to my channel and share this channel. That's very important. We are really progressing well. Okay, slowly and steadily we are reaching to more number of people. Okay, more number of students, and hopefully it is all your contribution, your support that's taking us forward. Okay, if the revaluation method is adopted, see, cost method is fine. Cost less accumulated depreciation and impairment. Is it? Impairment losses. If revaluation is method, see, this is where you say, when you revalue, see, when you are what's happening, you have purchased asset in the year 2016. You have done some, you want to do some calculations in 2023. Is it right? When you have purchased the asset, you said that the purchase assets will be for how many years? 10 years. You have purchased the asset, definitely there will be a historical cost. Is it? Historical cost is 20,000 pounds. Is it? 20,000. Now you want to make the revaluation. See, revaluation have very specific conditions. Revaluation should be made with regularity. Is it? To ensure that the carrying amount does not differ materially from the fair value. Means at each reporting day, annually. Is it? Regularity means annually. That's what it says. At time-based manner. Is it right? It has a time-based manner. That's very, very important. If the item is revalued, the entire class of assets to which it belongs to, means if you are saying that we are revaluing the land, okay? There are so many lands. So land 1, 2, 3, 4, 5. If we are saying that there are 5 different lands at different places, all the land should be revalued. So we should not be, is it right? We should not be selective in revaluation. This is the first point. It should be sufficiently regularly. It has sufficient regularly. We have to do revaluation on all the assets. If revaluation increases the value of the asset, it has to be shown, presented in OCI. See, this is a point where we are using it in calculations. If there is an increase in asset, it has to be shown in the other comprehensive income, and it should be held as a revaluation surplus with other components of equity. Means one side in the income statement, it has to be shown as a OCI, other comprehensive income. In the statement of financial position, it has to be shown in where it has to be shown in other components of equity. Sorry, other components of equity. Means when we have to show when the value of the asset is right, when the value of the asset is increasing. Is it? When the value of fair value, okay? When the fair value is increasing. If the revaluation decreases, if a revaluation decreases the value of the decrease should be immediately recognized what? Profit and loss account. Unless there is a revaluation reserve representing a surplus of the. If it is a decrease, is it right? If it is a decrease, we have to show it where we have to show it in the profit and loss account. Unless there is a revaluation surplus. If revaluation surplus, from the specific revaluation surplus, we have to make the adjustments. Okay, this is related to point 4. Coming back to this now, we have a very very general understanding about depreciation. Is that what are the key principles with respect to depreciation? See, is that when we say depreciation, depreciation should have again there should be some structured process should be there. All property, plant and equipment with the finite useful life must be depreciated. Is it? That means what is our cost minus scrap divided by life. This is the basic one. What is the residual value is only an estimate of the net selling. We are estimating that what will be the residual value at the end of its useful life. And if you are going to dispose it of today, what will happen? Means in general, residual value is a estimate. Point number 3. Depreciation is charged to the profit and loss account unless it is included in the carrying amount of another asset. Usually we will do depreciation will charge as a profit and loss account. Point number 4. Depreciation begins with asset is for use and continues until the asset is de-recognized. Is available for use. It begins with the available means if it is an asset is in use, definitely we will apply the depreciation till it is going to be de-recognized or it will be removed from the balance sheet. If it exists on the balance sheet, if exists in the statement of financial position, depreciation will be reflected. This is point number 4. Point number 5. Depreciation must be allocated on a systematic basis. Yeah, how it is, you see, that's what I say. It is a straight line. Methods are there, is right? We are talking in terms of method. How it is a straight line basis. It is a written down value method. Is right? Diminishing balance method. Units of production method. Is right? It is a double declining method. We have sum of years digit method. Means depreciation is done on a systematic basis, and hopefully further depreciation methods be based on the revenue generated by an activity. Revenue generated by an activity are not appropriate. This is because revenue reflects many factors. Revenue reflects inflation. See what will happen if we see. This is where historical cost. Is that historical cost? We take historical cost as a basis. But what will happen if you take into consideration revenue? Assume the asset. Is it that the asset is for 10 years? Is it deficit will definitely the revenue will the prices will increase. Is that when the prices will increase, the prices will have a component of inflation. Is that the prices will have a sales price will have a component of inflation. So that is one side we are taking the historical cost, and another side we are taking the revenue which includes inflation. Definitely there will be some mismatch. A depreciation method, residual value and useful life of the asset should be reviewed annually and revised if necessary. Any adjustment means if we are talking in terms of the depreciation method, what it says that we have to revise it. Sometimes what will happen, the life of the asset is that the life of the asset will decrease, or we can extend. Is it that we can extend the life of the asset? These are all assumptions, as well as it is part of limitations. Fine. These are the things which we have to. Now what happens if when we are talking in terms of asset, very interesting thing, when you are talking about the asset, we are not going to replace the asset will be there for 10 years. Okay, asset we are using an asset. Asset will be there for 10 assets, 10 years. Is it right? Take example of, they have given very good example. They given the example of aircraft. You take your own car. Is it right? You take your own car. When you take your own car, what will happen? See, they made it very clearly. If you say that, what is the componentization? Component. Means one part of the asset. It's not the entire asset, but that part of the asset will have a useful life of more than 1 year. Okay, that have a more useful life of more than 1 year as such. Now, what it says, they say that some parts of an asset may require regular replacement. Seats in the aircraft. If you take car also, car seats, is it right? If you take into car seats, aircraft seats, okay? It will require, after 2-3 years, we want to replace the seat covers. We want to replace in the aircraft, we want to replace the seats, because that is one of the component which is having a maximum wear and tear. Is it right? The maximum wear and tear will be there in terms of seats, okay? Should be capitalized. The replacement part should be capitalized and the carrying amount should be replaced. Old seats. Once we are saying it has to be re-recognized. If carrying amount of the replaced part is known, then the cost of the new replacement cost can be used to estimate the cost of replace. See, this is the point. See, what every line, every statement gives you a very clear meaning. If you are replacing the asset, the component of the asset, we have to identify what is the replacement cost, and if it is going to be replaced, what is the estimate the cost of replacement part when it is originally required. Some assets, such as aircrafts, can only be operated if regular inspections of faults are carried out. That means if aircraft needs regular maintenance, is that? And definitely when we need regular inspections, definitely we will make some replacements will be there. This cost of this expensive inspection should be capitalized. The remaining amount should be amount relating to the previous inspection should be. It means sometimes what will happen, you are taking an aircraft every 2 years, is it? Every 2 years it will require inspection. It will require inspection for overhauling. Is it? It will require overhaul. It means you want to make some changes. Is that what is in the first point what we have done? Any property, plant of equipment, it has to be useful life of more than 1 year. Right? That is the depreciation should be charged separately on each significant component. Means whatever the additional amount has been. See, in this case, if you take into consideration the seats, take an example, the seats will have a life of how many years? 3 years. Aircraft will have a life of how much? They say it is in terms of miles, how many miles it is going to fly. Okay, assume aircraft will have a life of 200 miles. Okay, now definitely assume it is going to be 4 years. Okay, means you should make a very distinct differentiation between the depreciation of the aircraft and the depreciation required for a specific component. Fine. Now, what we have done, see, we have done very systematically. We have done in terms of how it has to be measured. What is the conceptual framework in terms of IAS16? We have what are the measurement models, cost model and revaluation model, the concept of depreciation, the concept of componentization. And the next one, how do you have to de-recognize when disposal occurs, or if there is no further economic benefits, then you have to de-recognize. The gain or loss on de-recognition of the asset is between the how much we are getting net disposal as proceeds, if any, and the carrying. What is the carrying amount? Carrying amount Is it? Carrying amount is nothing but cost minus accumulated depreciation. Is it? Cost minus accumulated depreciation. And any net disposals will be there definitely. In that case, what will happen? Net disposals will be less, carrying amount will be more. When a revalued asset is disposed of, any revaluation surplus may be transferred directly to the retained. Why we are transferring directly to the retained earnings? There is no further continuation of the asset in the statement of financial, because no further continuation of financial asset, non-current assets. Is it non-current asset in the statement of financial position? That is the reason we have to, it may be left in revaluation surplus with other components of equity. How the disclosure, when it is going to be recognized? We have to mention what is the basis of measurement, what is the useful life and depreciation rates, and we have to make a reconciliation. Always make it a point. At any point of time, there is a reconciliation. Reconciliation is nothing but what is the value at the beginning and what is the value at the end of the period, plus any adjustments if it is done, and what is the difference. If items of property, plant and equipment stated at revalued amount, information about the revaluation should also be disclosed. That is the reason why we say it is faithfully represented. Fine. Now, coming back to this, very specific, very okay. I will put one line here. I need lot of space. Okay. CAP bought a building. We put here the solution. Okay, we put here the solution. CAP bought a building on 1/1/2001. How much is there? The purchase price is 2.9 million. Associated with the legal fees, how much? Legal fees is 0.1 million. And general cost is right. And general cost is how much? General cost allocated to purchase is how much? 0.2 million. CAP also paid sales tax, is it? They have paid sales tax. How much they have paid sales tax? 0.5 million, which CAP has recovered from the tax authority. The building has a useful life of how many years? Building has useful life of 50 years. It has revalued 4.6 on 31st. On 31st, is it right? On 31st December 2004, it has been revalued at how much? It has been revalued at 4.6 million, and was sold how much? On 31st December 2005, it has been sold for how much? It has been sold for 5 million. This is regarding the one asset. Okay, one asset. On CAP purchase a machine. We'll do that at a later stage. Okay, we'll do that at a later stage. Now this is what it says. Now, how much is the value of the building? General cost we should not take. Sales tax, they say that sales tax will be recovered from the tax authorities. That we should not take sales tax also. Means cost of the building will be how much? Cost of the building will be 2.9 plus legal fees is there 0.1. Is it right? Cost of the building is how much? 3 million. Was it? We are not taking. Why? Because see the thing I mentioned. I'm just saying this the tax will be recovered from the tax authority, and what is the clause? It say that general expenses should be debited to whom? Debited to profit and loss account. Okay, fine. That's what it says. Now, how much is the depreciation? Is it right? How much is the depreciation? First, they have when they have revalued, they revalued to 4.6. Is it right? Depreciation. Is it depreciation? Depreciation from when? Depreciation from depreciation from 1/1/2001 to 31/12/2004. Is right? 1, 2, 3, 4. For how many years? This will be for 4 years. Is it right? This will be for 4 years. They have mentioned anything on the scrap? No. It comes to how much? It comes to 3 million divided by 50 years. Is it right? 3 million divided by 50 years. It comes to how much? 3 million divided by 50 years times 4. Is it right? 3 million divided by 50 years times 4. It comes to how much? 0.06 million per year. Is it right? For 4 years, it comes to how much? For 4 years, 0.06 times 4, it comes to 0. How much is it? It is in dollars. 0.24 million. Is it right? 0.24 million. Now, value of building. Is it right? Value of building will be how much? Value of building is 2 million as on 31/12/2004. 3 million. Is it? 3 million minus 0.24 million. It comes to how much? It comes to 2.76 million. Is it right? 2.76 million. Now, there is a revaluation. Is it? There is a revaluation has been taken place. Revaluation gain. Revaluation. Is it right? Revaluation. How much is the revaluation price? 31. What they have mentioned? It is revalued amount is how much? 4.6. 31/12/2004. It is how much? 4.6. Is it right? Carrying amount is how much? Carrying amount is how much? 31/12/2004 is 2.76 millions. Is it? 2.76 million. 4.6. Is it right? How much is the revaluation gain? 1.84 million. Is it? This is the revaluation gain. Is it? Revaluation gain. Fine. 1.84. What we have to, how we have to mention here? Revaluation gain is, it has to be transferred to, fine, revaluation gain. Now, this is the first part. Okay, this is, I will write here, this is step 1. This is step 1. Is it right? This is step 1 and this is step 2. This is step 3. Now we have to calculate depreciation. Is it depreciation year ended 31/12/2005? Okay, depreciation for the 31/12. What is the revalued amount? Revalued amount is how much? Revalued amount is 4.6. Is it right? Number of years. Number of years remaining. We must have remaining is how much? 50 minus 4, 46. Is it right? Depreciation per annum. Is it right? 4.6 divided by million divided by 46 years. It comes to how much? 1 million. Sorry, 4.6 divided by 46. Is it 4.6 divided by 46? It comes to how much? It comes to 0.1 million. Okay. Now carrying amount is how much? Carrying amount 131/12/2005. It how much? What is the beginning amount? It is 4.6 million minus 0.1. Okay, this is the depreciation. How much is the carrying amount as on 31st December 2005? After depreciation, it is going to be 4.5 million. Okay. $4.5 million. Now what they have said, this is they have sold it for how much? They sold it for 5 million. Is right? They sold. This is step 4. Okay, this is step 4. Is it profit on disposal? Profit on disposal. How much is the carrying amount? Is how much? Carrying amount is 4.5 million. Is it right? The sale proceeds are how much? Sale proceeds are 5 million. Okay, so what is the profit? Profit is 0.5 million. Is it? This is the profit on disposal. Profit on disposal. Here you have to write the journal entry. Okay, you have to write the journal entry. How is the journal entry? 1.84 revaluation gain. Okay, if it is revaluation gain, it will be on the retained earnings. Okay, retained earnings is 1.84 million. Is that retained? And it is going, debit will be how much? They say debit will be other components of equity. Is that debit will be other components of equity? How much? 1.84 million. This is the way we have to work out how the things will go. See, if you take the examination question will be, they will give a scenario, and one of the adjustments is they will give like this. That's all. Nothing more, nothing less. They will give like this, and we have to work it out on that basis. Okay. Next. What they say, car purchased a machine of cap purchased a machine of on 1st January 1000, and its useful life is 10 years. On 1st January 2005, after 2 years, they reduced the estimated remaining life of how many years? Previously it is for 10 years. Now it has been reduced it for how many years? For 4 years. Okay. It is they have reduced it for 4 years. Fine. Now, First, what you have to do again. See, my approach is very specific. I will everywhere I will write step 1, step 2. Is it right? Depreciation. Depreciation from 1/1/2003 to 31/12/2004. 2 years. Okay, 2 years. Because on 1st January 2005 they have reduced the life of the asset. Okay, how much is the cost? Cost is depreciation is cost is how much? Cost is 100,000 divided by 10. Is it right? It comes to how much? It comes to if we take it for 2 years, is it right? If we take, this is for per annum. If we take for 2 years, is it right? If we take it for 2 years, how much? It will be 20,000. Carrying amount, okay? Carrying amount as on 31st December 2004. How much is there? I am taking very shortcut, okay? Minus 20,000 is the depreciation. It comes to how much? It comes to 80,000. Is it right? Now, they have made it for 2. Now, depreciation for the year, is it right? Year ended 31st December 2005. Is that cost is how much? This is the carrying amount. Is it right? This is the carrying amount. Remaining life is how much? 4 years. Is it right? 830,000 divided by 4. It comes to how much? It comes to 20,000. Whenever the things, it says that when you are revising the cost, when you are revising the life of the asset, from that day onwards you have to recalculate the depreciation and the carrying amount as such. This is the first part. This is related to IAS 16. Fine. Now, see, I will take three sessions here. The first two. There are 6 standards. Every session I will cover 2 standards each. Is it? Now, you are talking about the government. See, government will give grants to the companies. Is it? It comes under which category? It comes under IAS 20. Is it? It comes under IAS 20. What is the government grants is defined as? Government grants are the transfer of resources to the entity in return of the past or future compliance with certain conditions. That's very specific. They exclude assistance that cannot be valued. There are certain basic conditions are there. What are the conditions? Government assistance is government action designed to provide economic benefit to the specific entity. It does not include indirect help, such as it will not provide help for. It does not include indirect help as an infrastructure development. It means very specific for the past or future compliance with certain conditions. In return to an entity, in return for past or future compliance. Most of the countries, they will give assistance to the company, something like tax holiday, something they will give as a grant for the land expansion, something they will give subsidy, something they are making it for in different ways. Okay, IAS 20 says that God should not be recognized until the conditions of receipt has been compiled with and there is a reasonable assurance the grant will be received. See, government grant is nothing but, see, unless it is received, is that, that's what it says. What we are doing, we are talking in terms of realization concept, okay? unless it is not received, unless it is have not been reasonable assurance. Is that two things are there? Is that there should be there is a reasonable assurance that the grant will be received. Fine. The same thing which we have done in financial reporting, we are following the same concept as such. Grants should be matched with the expenditure to which they are intended to, means we should not mismatch it in the statement of profit and loss. Income grants given to subsidize expenditure should be matched to the related. Means if the grants are given for anything to with respect to income, we have to match with the related cost. Income grants to help given to help non-financial goals. Why the government will give grants to for if you as a company, if you generate employment, is right? It's contribution of towards the economy. Government will give grants. They will say they are subject to the condition. Yes, we will give grants, but you have to generate employment. Should be matched with the cost incurred to meet that goal as such. Fine. Now, grants related to assets. There means first thing what they said, it is how we have to recognize. Okay. Now there are various different ways. Is it grants related to assets? Grants for purchase of non-current assets should be recognized over a expense. Means when you are receiving the grant, is it right? You are receiving the grant in 2023, and they are receiving the grant for a non-current asset, and the current it is for how many years? It is for 10 years. Is it right? What is that you should not recognize in 2023 also? IAS provides two acceptable policies: deduct the grant from the cost of the asset and depreciate the net cost. Is that deduct the grant from the cost of the asset and you have to deduct. Treat the grant as a deferred income and release to profit and loss account over the life of the asset. Means again they are saying that make it a point that how it has to be. Either you should deduct the grant from the cost of the asset and depreciate the net cost, or you, if it is for 10 years, make it for 10 years. Every year proportionately you have to deduct it. And a government grant that becomes repayable is accounted for a revision. See, if you are not fulfilling the requirements, okay, see, if you are not, if a firm is not fulfilling the requirement, definitely there will be one clause in that grant that it has to be repaid. Is it? Firstly, in that case, what will happen? Debit, it's as simple as debit the repayment to any liability for deferred income. Any excess must be charged to the profits immediately. There are various things. Is it? When it is related to income-based grants, what is the repayment? Capital-based grants deducted from the cost, increase the cost of the asset with repayment. Definitely, we are repaying the thing, the cost of the asset will increase. When receive the grant, the cost of the asset will decrease. When you are repaying the grant, the cost of the this will also increase the amount of depreciation. Definitely, cost of the asset is increasing, the depreciation amount will proportionately increases. And what is the capital based grants? First, debit the repayment to any liability for deferred income, and any exchange it has to be done with respect to profit. These are very, very important points. See, if you read the points and if you go forward, the clarity will be more. If you don't read the points and go forward, the clarity will be less. Fine. So I am taking time just to make sure that how it will work. What is an implied? As implied, the definition set government assistance helps businesses through advice, procurement policies. It is not possible to place reliable values on these forms of assistance. It means when we are talking in terms of government assistance, is that in terms of advice, in terms of policies, they will say that is you can buy the products at a lesser rate. You can buy the products at a at a reasonable with reasonable subsidy as such. Okay, means that is the reason. There is, see, this all it is all the situational based judgments we have to take. IAS 20 requires the following when we receive the government assistance. The accounting policy and present, we have to mention what is the policy and presentation method. As simple as it applies to all, it applies to this standard also. What is the nature of government grants and how the unfulfilled conditions for relating to government had been recognized. If there is any unfulfilled conditions, it happens is that the government will give grants for 10 different conditions. Is it right? 10 different conditions. Definitely, we will slowly each and every condition will be satisfied. Okay. Sometimes if for over they gave a grant for how many years? They gave grant for 10 years. Now every year you will follow each and every condition over a period of time. Which conditions has been fulfilled? Is it right? Which conditions has been fulfilled, or which conditions have been met, and which conditions has been unfulfilled? Be very transparent in terms of the government grants as such. Okay, we'll cover this and we'll stop. Okay, we'll take this and we'll make it a point. Okay, now same thing. I'll put one line here, and for this there is a solution. In the next session, I am going to do with respect to borrowing cost. Okay, now discuss the possible accounting treatments for the above in the financial statements. Make it a point. Even sometimes I will miss. Okay, sometimes I will miss, but I will keep that in mind. You always make sure that first you have to read the requirements. Okay, even as I say, we will miss it, but that is one of the checklist. Okay, for us in examination also make it a point. Discuss the possible accounting treatments of the above in the financial statement for the year ended 31st December 2001. On 1st June, Clock received return confirmation from a local government agency that it will receive 1 million grant toward the purchase of new building. It is a reasonable assurance, is right? It is reasonable assurance. The grant becomes receivable on the date that the Clock transfers 10 million purchase price to the vendor. That means there is a condition attached to it. On 1st October, Clock paid 10 million in cash for this new office building, which is estimated to have useful for 50 years. By 1st December, the building was ready for use. Clock received the government grant on 1st January 2002. Okay. Now, see what is just for our understanding. Okay, just for our understanding. Just for our understanding, what is the government grant? Is it? What is the government grant? It says that, is it right, that there should be recognized when there is a reasonable assurance. Is it? The entity will, what it says, they have to comply with conditions attached. Okay, conditions attached. And there is that they are going to, the grant is going to be received. Is right? Grant to be received. All three things have been given here. Is right? There is a reasonable assurance. clock received return communication confirmation is nothing but a reasonable assurance. Is it reasonable assurance? Discuss the possible, is it possible accounting treatments. Possible is measured more than one. Okay, possible means more than one. And what we have to see, what it has been given, there are two things has been mentioned there. Is it right? What we have the grant reserve. See, these are the two things. Deduct the grant from the cost of the asset and depreciate the net cost, or treat the grant as deferred income. Okay, these are the possible outcomes. Okay, these are the possible outcomes. Fine. Now reduce the cost. Is it right? Reduce the cost of the building. Is it right? Reduce the cost of the building. How much is the building cost? The building cost is 10 million. Okay, how much is the clock transfer for purchase from the building? Is it right? What is the building cost? Building cost will be how much? Building cost is how much? Building cost is 10 million minus 1 million. Because they are receiving grant how much? They are receiving grant to the extent of 1 million. It comes to how much? It comes to 9 million. Is right? It comes to how much? It comes to 9 million. Now, when they have said it is for June 1st, is it right? June 1st. And when they are going to calculate it, it is going to be on 31st December. Means it is for how many months? It is for 6 months. Okay, it is for how much months? It is for 6 months. Depreciation, is it? Depreciation is how much? 9 million divided by how many years? 9 million divided by 50 years, is it? Into times 6 by 12. Is it? 9 divided by 50 times 6 by 12. It comes to how much? It comes to 9 million. 1 minute. June 1st, clock received return confirmation. Fine. It has been ready for use when 1st December. Is it right? It has been reduced when it is ready for use for 1st December. And we have to do it for how much? Means depreciation will be for how much? Depreciation will be for 1 month. Okay. Depreciation is for how much? Depreciation is for 1 month. Means 9 by 9 into 9 by 50 times 1 by 12. Is that 9 divided by 50 by 12? It comes to how much? It comes to 0.015 million or 15,000. Okay. Now, what is the carrying amount? See, carrying amount is how much? Carrying amount is, you have the 10 million. Depreciation is how much? Depreciation for 1 month. Okay. Depreciation for a month. How much? 0.015. Okay. 0.015. It comes to how much? Is it 1 minute. Carrying amount is how much? Carrying amount is, we have to take the net cost. Okay. What it says that we have to deduct the grant from the cost of the asset and depreciate the net cost. Okay, means how much is the net cost? Carrying amount is nothing but what is the net cost? Net cost is going to be 10 minus 1 million. Okay, it comes to how much? It comes to 9 million. Fine. We have to take the net cost. Okay. Now how much is there? If you take 9 minus 0.015, it comes to how much? It comes to 8.985 million. This is the carrying amount as on 31st December 2001. That's what they are asking, 31st December 2. This is with respect to what? See, again I am giving reference. This is with respect to what? This is with respect to the deduct the grant from the cost of the asset. Fine. Next one. What they are saying? They are talking in terms of if you deferred income. Treat the grant as deferred income and release to profit and loss account over the life of the asset. Okay? Over the life of the asset. Yeah, this is the option 2. Okay, this is the option 2. This is the option 1. Yeah, we can do in is it? We can. This is the option 1. This is the option 2. Now what it says in option 2, we have to defer. Again, go back to the condition. That is the reason we have to treat the grant as deferred income. This is one it says, is right? Treat the grant as a deferred income and release to the profit and loss account over the life of the asset. Now, what is the building cost? Where the building cost is how much? Building cost is 10 million. Is it right? Building cost is how much? 10 million. Life is how much? Life is 50 years. Is it? Life is 50 years. Now, depreciation for 1 month. Okay, depreciation for 1 month. Again, I will say 1/12/2000, 1/12/2000, 1/31/2001. Okay, now how much is there? 10 million divided by 50 years times 1/2. 1/12. Okay, it comes to how much? It comes to 0.016 or 16,667. Okay, 16,667. What is the carrying value? Carrying value is how much? The carrying value is how much? 10 million minus 0.016. Okay, 10 minus 0.016. Is it right? It comes to how much? 9. It comes to how much? It comes to 9.984 million. 83 or 84. Fine. Is it? Now, this is what is the deferred income? Deferred income will be how much? Deferred income should be amortized. Okay, deferred income should be amortized in profit and loss account. How much you have to amortize in profit and loss account? Same thing. Is it right? How much we have? Grant divided by life into number of months. Okay, how much is the grant? 1 million. Okay, 50 years. Is it right? 1/2. Is it right? How much will come? It will come to 1 divided by 50 divided by 12. It comes to 0.00166 or 1667. Is that this much amount should be recorded in the profit and loss account? Okay. Now, what is the carrying amount of the in the financial position? Carrying amount of the grant. Carrying amount of the grant will be how much? Carrying amount of the grant is 1 million. Is it 1 million minus 0.00166? Okay, 1 minus 1. It comes to how much? It comes to 0.998333 or 998,333 million. Okay, this is the amount to be shown. This is the amount to be shown in the statement of financial position, and this is the amount to be shown in the profit and loss account. Very important. Okay, very important. This much we have to think in terms of today. What we have covered? We have covered IAS 16 and we have covered IAS 20. In the next session, we will carry forward with respect to every 3 sessions. Every session will have 2 standards. We will cover it in detail and we will apply it as applicable. Okay. I will request you to subscribe to this channel, share this channel. We have to reach as many students as possible for the benefit. Okay. So thank you so much. Best of luck.